Think you need $100,000 in the bank to actually buy your first rental property? Well, that's not true. There's multiple ways on how to fund your first deal or your next deal, even if you work a 9 to 5 and you don't know where to even get started. Today, I'm gonna break down multiple ways how to do this so you guys can get started on buying your first rental property. You ready? Let's go. I'm Thach Nguyen. I've been investing for over 30 plus years, and I own actually hundreds of property in the Seattle market area. Today, with my good friend Israel Lopez. He's the top harbor lender across the nation. And today, we're gonna actually share some of the most common way how to fund these rental property, right?
Let's do it.
And if you've been thinking about investing in real estate and retire off a rental property, today, we're gonna show you how to do that. Let's go. All right, so let's talk about the first option. This option right here is for people that don't own any rental property yet, but they wanna get into their first property. Now, we're gonna call this option right here minimum down payment, and it's a great way to actually what they call house hack. Live in it, and maybe rent out a portion of your property so you can actually help cover your mortgage. This first option, we're gonna call FHA and conventional financing. Now, from what I understand, FHA, you need a minimum of 3.5% down. They can do minimum like 620 credit score, but I always like to say, you ideally wanna get close to like 680 to get better rates. Now, conventional is like minimum 5. And again, ideally you want your credit score to be closer towards like 680 to get better, rates. These are the two options that the first time home buyer / house hack use to actually get in with very low down payment. You want to add to that?
Yeah, basically how these banks are qualifying you as an individual to qualify for these loans is they're looking at how much money you're making on an annual or monthly basis. And at the end of the day, they really want to see that your monthly debt obligations, whatever it is, car payments, student loans, is no more than 50%. So that way you can get approved to go ahead and make that purchase on that first property.
So this is a great option to get into your first rental. Now, I'm gonna say if you don't own a property yet, ideally what you wanna do, you wanna find a house where you can rent out some of the bedroom or a house with a basement like that, where you can rent the basement out, right? Or even a duplex, triplex, fourplex, where you can actually rent out a portion of it so you can cover your mortgage. If you say underneath 4 unit, it's still considered residential loan. Is that correct?
Exactly. And on top of that, you want to make sure that if you were to move out of that property, that the rental income of that property is able to sustain that mortgage so you can continue to buy more properties.
That's right. So you don't need to buy a mansion in the first property. Just get a nice starter home, right? Now you know that when you move out, probably a year later, typically most people, right, you can rent it out and at least cash flow. All right, let's talk about option 2. And again, this option right here is still great if you don't own a house yet, okay? This is a great option, again, house hack. But this option here, you can get into a property with 0 down payment. What this option is called the VA loan. VA loan is for people who actually has served in the service, right? Either they're vet now or they're still in the service today. They can buy a house with 0 down payment. Now, you still gotta have credit. They say that you gotta have a minimum of 620 credit score and higher.
Yep,
right?
That's exactly correct.
But you still gotta qualify to get the loan. So how do they qualify, bro?
They basically will look at how much money you make on a monthly or annual basis. So for example, let's say you make $10,000 a month, $120 a year. That means that on a monthly basis, they'll want to see you have no more than $5,000 in debts, and that's how they'll get you qualified.
Yeah. So if you are, eligible for the VA, use that opportunity. Use that, okay? And then if you want to buy something after that, you can always put money down to buy the next property. But if you don't own no property, use this VA to your advantage. And again, if you use this 0 down, try to find a house where you can rent partial your house out, basement or duplex, triplex, fourplex. And remember, when you move out of this later, okay, you can use this opportunity to rent it out and then go buy your next property as your primary house, again with low down payment. All right, here's another option on how to buy your next property. Not your first property, but your next property with little to no money out of your own pocket. This option is a HELOC. HELOC is basically home equity line of credit. If you already own a primary house, you got a lot of equity there, you wanna buy your next property, instead of coming cash out of your pocket, you can use some of the equity out of those primary houses you own, right? And then use the equity to actually use that money for the down payment of your rental property. That way you don't have to come out of pocket. So this is literally 0 money out of your pocket, other than just moving some equity from your primary over to another property, okay? Now, there's a few things you gotta know when you do HELOC, okay? Let's talk about the difference between rates on a primary HELOC and then a secondary property.
When it comes to securing a HELOC on your primary residence, the rates are about 1 to 2% cheaper as if you're getting a home equity line of credit on your rental property. And on top of that, securing a HELOC on a primary residence is a lot easier than a secondary or rental property. When you try to secure a HELOC on a rental property, there's less lenders operating in that space. So a lot of times it's a little bit tougher. So make sure you lock in that HELOC while you're occupying that property as a primary residence to secure the best rates, and make sure that you lock that HELOC in so that way you can deploy that capital into that next rental.
You live in a primary, get a HELOC on. Even if you don't use it, just get a HELOC on it, okay? If you got rental property, right, and you have the opportunity to put HELOCs on, put those on there also. I have a whole bunch of HELOCs on a lot of my rental property and my primary in case I find a good deal. I want to strike early and fast. I can use that money to buy it down. So yes, cheaper to get rates on a primary than a rental property. All these strategies I talked about, it worked. Sometimes it is overwhelming what type of loan works best for the product. It all comes down to this, okay? You gotta know the end game. Are you buying the fix and flip, or are you buying the fix and hold? Then based on that, then you're gonna know what type of loan fits best for fix and flip and fix and hold, right? And do you do basically, you know, DSCR loan, or do you actually do conventional, right? When do you use VA? What type of loan can you get for ADU? This is where it gets a little confusing, and that's why I am putting together this week a 5-day challenge on how to go over all this starting October 13th. Make sure you guys come join me. Link is below in the description. Come join me. All right, let's talk about option number 4. This option right here is for investors who already own a primary and they want to actually start buying rental and start scaling. Now, this option done right, you can put down probably little no money and borrow most of the money from friends and family and hard money lending. This option is called private money / hard money lending. Let's talk about private money. What is private money so you understand what that is?
Private money is essentially if you go out to friends and family and ask for a loan, and they go ahead and put a mortgage on the property.
Yeah.
So let's say you need to go buy a property. You say, Israel, hook me up with, I don't know, a couple $100,000.
Right.
Send it to you, and we're off to the race to go ahead and buy it.
Because most of the time when you buy a fixer-upper or rental property, even turnkey, you know, you need 20%. Some people don't have 20%. So what happens, they use other people's money, OPM, right? So Israel lend me, 20%. I use that money for a down payment, and then I use the bank to finance the other 80%. That's how the investor buy with no money out of their pocket. Now, there's a risk behind that. You better know how to do the real estate game well, because if you lose that deal or that money, then it can be a hard Thanksgiving conversation, okay? Now, let's talk about they got the 20%, or they don't need 20% from their friends and family. They put 20% down. How does hard money lending work after that?
So hard money lending is beautiful because you can go ahead and buy properties that don't qualify with conventional financing because of debt to income or the property's in disrepair. But essentially, to qualify for hard money, you need 3 main things. Ideally, do you have the money for the down payment, which you would have found somewhere? Ideally, a 660 credit score or higher. And then from there, the most important piece is, does the deal have a 20% margin or higher?
That's it. Now, you can use the hard money lending to fix and flip or fix and hold, okay? And that's what people use it for. And then the last option is called option 5. It's called DSCR. Now, in option 4, we're talking about, buying a fixer-upper or buying a turnkey, how you use hard money lending, right? After you use it, you can put your own down payment up or use your friends and family for the 20%. And then, hard money lending, which is owned by us, Springboard Funding, we can fund it for you. You can buy it, fix and flip it, okay? Then you cash out Springboard Funding, and then you take the profit. But if you want to actually fix up and keep it as a rental property, this is where you need a refi out of the hard money into a DSCR loan. Why don't you explain to them what that is?
The DSCR loan in itself takes a commercial concept of underwriting and brings it into the residential space. So we're no longer looking at your debt to income and how much money you make as an individual. We're looking at how much rental income the property is generating, and the rental income there is making the monthly mortgage payment. So let's say you make $3,000 in rental income. The maximum that DSCR loan will qualify is for a $3,000 mortgage.
That's right.
And that's the crux and cranny of it, where you can go ahead and buy more properties beyond the traditional limitations, where with traditional financing, typically they'll allow you to buy up to 10 properties, and they won't let you buy stuff in an LLC, where DSCR will.
That's right. So you see, this is how people are scaling, okay? And this is why you gotta know what basically options you use based on the type of loan you use, the exit strategy you use. And we have all the different strategy loans that we can actually help you, either a first-time home buyer or an advanced investor. All right, that's a wrap for this video on how to fund your first or your next rental property. If you have any question about what we talked about today, put it in the description, okay? We'd be happy to get back to you. If there's any other topic you wanted to discuss, let me know. I'll be happy to help you guys by making more of these videos for you. Hopefully you guys like it. If you like it though, you gotta make sure you give me a thumbs up and make sure you hit the subscribe button and make sure to send this to your friend, right? Have them come check out the channel and subscribe to the channel also. We can make more content for all you guys and gals, all right? Until then, I'll see you guys on the 5-day challenge. Peace.